Wow, a lot has happened over the last 30 days. Globally, the stock market fell 7.5% and at one point as much as 8.7% from its peak in mid-July, erasing a large part of its gains this year. And while our FTSE All World ETF is still up 7.97% in 2024, that's a significant drop considering we were up 16.71% just 2 to 3 weeks ago. Looking at the ETF portfolio I shared with my wife in actual numbers, we were at one point down as much as 33,200 euros or minus 9% before recovering a bit since yesterday. Luckily, we're still up 22,600 euros year to date, but it's nonetheless a significant difference compared to mid-July. Now, let's see how this impacted our overall returns since we started investing in ETFs back in 2017. After the most recent drop, the average yearly return of our ETF portfolio now stands at 10.15% per year, so we definitely have nothing to complain about just yet. Meanwhile, the American Fear and Greed Index has now gone into extreme fear territory, showing that many investors got scared by the sudden decline in the stock market. I can't blame you if you were as well, especially if you only started investing recently and got used to the market being up almost every month since the start of 2023. But this is a normal part of investing. Pullbacks like the one we just saw at minus 9% or corrections of minus 10% or more tend to happen on a regular basis. In fact, here's a great table showing you how often the American S&P 500 index had days where it was down 1%, 2%, 3% or more historically. Periods like the one we're currently going through serve as a good reminder that the market is volatile and that you should always treat ETFs as long-term investments, not something to jump in and out of based on the latest news headline. You should have a time horizon of at least 5 years, ideally 10 years or more when investing into ETFs. And with time, you may start to see drops in the market as discount opportunities to buy shares of the most productive, most profitable companies from all over the world at a lower price. Still, I want to know how you experienced this market pullback. Were you worried or were you relaxed? Let me know in the comments below. Now, after my decision to exit peer-to-peer lending last month, I told you that I was moving 80% of my funds from that sector into low-cost ETFs on an ongoing basis. Well, here's an update on that. So far, I've already been able to withdraw 28,800 euros, and just as I had planned, I already invested 80% or around 23,000 euros into ETF shares. As you can see here, I bought the Vanguard FTSE All World at the start of July and then started buying the Invesco FTSE All World due to its lower fees and it now having become a worthwhile alternative to Vanguard's fund in my opinion. If you want to learn more about why my wife and I decided to start buying Invesco's ETF, make sure to check out this recent video of mine. And yes, sadly we pretty much invested everything before the most recent drop, but oh well, that's life. By the way, you can find the best low-cost brokers in Europe to buy ETFs down below in the description, which is a great way to support me if you'd like to. And speaking of passive low-cost ETFs, SPDR just lowered the fee of its accumulating MSCI All Country World ETF to 0.12%, which now makes it the cheapest ETF that's covering that index by a significant margin. In my opinion, this is now another excellent pick for passive global ETF investors. You can find it using the ticker SPYY on Interactive Brokers and Trade Republic. I've been really impressed by what SPDR has done over the past 2 years. First, they lowered their All Country World Investable Market ETF to only 0.17% in 2023. By the way, they just launched a distributing version as well. Then they reduced their S&P 500 ETF to only 0.03%, undercutting other fund providers. And now they're also offering the least expensive MSCI All Country World ETF in the market. At the same time, Vanguard has kept its fees unchanged for close to 5 years and now stands out as one of the most expensive global ETFs with a total expense ratio of 0.22% per year. I never thought I would ever see this sort of profit-driven behavior by Vanguard considering their stated mission on their website. Vanguard is a different kind of investment company. It was founded in the United States in 1975 on a simple but revolutionary idea: that an investment company should manage its funds solely in the interests of its clients. It's what we stand for, value to investors. And that's certainly true in the US, where they keep lowering fund fees on an ongoing basis. The most recent example is how they lowered the similar but even broader Vanguard Total World Stock ETF from 0.08% to 0.07% in February of this year. I think most of us, me included, were expecting that they would keep their fees competitive in Europe as well. As a result, I've become a bit disappointed in Vanguard as a fund provider as of late, and I hope this is going to change very soon. Getting back to SPDR, I would have zero issues picking one of their All Country World ETFs for my monthly ETF investments, but last month I decided to go with the Invesco FTSE All World instead, mainly due to the fund provider being significantly more tax efficient throughout the holding period in Austria. If you're not in Austria, this part is irrelevant for you though. Let's now quickly move on to Trade Republic, one of the brokers I use the most, not just for ETFs, but also as a high-yield savings account. That's because I'm able to earn the exact ECB interest rate of 3.75% per year on my uninvested funds, secured by a €100,000 bank deposit guarantee, which netted me a record €80.25 in interest on my savings in July, plus an additional €15 from the 1% Saveback using the Trade Republic card for our expenses, which went into the Invesco FTSE All World ETF. As for my small speculative allocation to crypto, which I aim to keep at around 10% of my portfolio, after it looked like Bitcoin was on its way to reclaim previous all-time highs at the end of July, it saw a sharp drop in line with fears in the stock market. Sadly, at the moment, it's clearly correlated to other risk assets like stocks. That being said, with a year-to-date performance of plus 36%, it's currently still my best performing investment in 2024, and I remain bullish about the rest of the year. Meanwhile, Ethereum has been very disappointing, there's no other way to put it. The second largest crypto asset has lagged far behind Bitcoin for a while now, which is clear when looking at its BTC chart. And in euros, Ethereum is now up only 11% since the start of 2024, and is still very far below its all-time high of €4,066 from November 2021. Since I'm not sure about Ethereum's future at the moment, with competitors like Solana gaining more and more strength for its use case, I've decided to only buy a bit of Bitcoin on a monthly basis for now. I'm going to hold on to my Ethereum until the end of the year and will then decide whether or not to sell this position entirely. Either way, crypto is highly speculative and carries a ton of risk, so please limit it to a small percentage of your portfolio if you decide to dabble in the sector at all, as it's certainly not for everyone. Alright, that's pretty much everything that has been going on with my investments over the past 30 days, which were quite eventful to say the least. How did you experience the pullback in the stock market? Were you worried, or were you relaxed and perhaps even able to take advantage of lower ETF prices? Let me know in the comments. Before you take off, don't forget to gently tap the like button and to subscribe if you haven't yet. If you'd like to support me, feel free to use my links in the description below to the best low-cost brokers in Europe for ETFs and other financial tools I use. And of course, none of what I talked about today was meant as investment advice. I'm just openly sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching. Have a wonderful day, and until next time.